Africa's economic growth will accelerate from a low of 2.6% in 2023 to 3.4% this year. That's according to the latest forecast from the World Bank in its Africa Pulse report. The recovery, the bank says, will primarily be driven by greater private consumption growth, as declining inflation tends to boost the purchasing power of household incomes. That said, the pace of economic expansion in the region is still below the previous rate of the previous decade, somewhere between 2000 and 2014. And the bank says it's insufficient to have a significant effect on poverty reduction. Africa faces several hurdles, including uncertain global economic conditions, growing debt service payments, frequent climate-related disasters, and escalating conflict and violence in various parts of the continent. Let's dig a little deeper into that report. Andrew Dabalaen is the chief economist for Africa at the World Bank, is joining us now live on the program. Andrew, good to have you on the program tonight. Thank you so much for your time. Let's start with the debt side of things. Public debt levels are forecast to fall in aggregate, right, from 61% to around 57% of GDP. But what exactly is driving that decline in debt? Is it because governments are borrowing less and they're running smaller deficits, or can we attribute some of that decline to the debt restructurings we're seeing in some countries?
Rama, thank you so much for having me on your program. I would say it's the combination of the first 2 points that you mentioned, right? Fiscal balances have declined, and that's partly because governments are raising more revenue or reducing spending, or both. And what we find is that fiscal balances are going to decline from about 3.8% of GDP to about 3.5%, and then by 20. So it's the measure taking to bring revenues and spending in balance that are paid. Net debt have also declined from about $45 billion in 2019 to almost half of that in 2022. So those two, both the government borrowing less and running deficits, are the cause of the decline in.
We've also seen Zambia run into this comparability of treatment problem, at least within the context of the G20 common framework over the last year. From where you stand at the bank, what needs to be changed to make the common framework a much faster debt resolution process, as Ghana and Ethiopia go through it at the moment?
Yes, indeed. And I think, we should all cheer the recent resolution of the Zambia debt issues, that the common agreement that they have reached with their creditors. Now, in the World Bank, we think that there are 4 things that need to be done in order to be able to actually make G20 common framework much faster and much more substantive. So the first thing is, as we've seen in the case of Zambia, to make sure that you bring commercial creditors to the negotiating table from the very start, given the significant share of commercial debt in common frameworks are eligible. That's the first thing. The second is to establish a formula applicable to all creditors to determine comparability of treatment and ensure there is equal burden sharing. And then, it's really important that we think about a way to suspend, for the duration of negotiations, the obligations of the common framework applicants to make debt service payments. And in the World Bank, we've also called for expanding perhaps the eligibility to more countries, so that highly indebted and vulnerable countries can benefit. And so at the moment, it is all the common framework is applicable to only the countries that are low-income countries, but there are countries in the low-middle-income countries that are in a way quite vulnerable and highly indebted, and they could potentially benefit from the same treatment.
Given those changes that you're suggesting, should the World Bank or the IMF, act as a referee in the event that there's a dispute between bilateral creditors on one hand and commercial creditors on the other? Because my impression of what happened with the Zambia case is, we had these two parties saying, actually, no, we don't agree with what you're essentially, the amount of debt relief that you're giving. But there wasn't one party who could sit down at the table and say, look, guys, this has to stop, right? You need to give this sort of compromise, and you need to give this kind of compromise. Is the IMF the ideal referee for this sort of thing?
Such a role is something that we can't just individually claim as organizations. I think it's really important for both the international community and both the creditor and debtor nations and parties to be able to say, we need a third-party arbiter and assign the responsibility to that third-party arbiter. I think unless that happens, it's very difficult for the World Bank and the IMF to unilaterally come in and say, we're going to arbitrate the dispute and the differences here.
Indeed, certainly something perhaps the finance ministers and central bankers need to talk about in the next G20 meeting. Let's talk about fiscal slippage, though, because that also came up in the report, and you're warning against it, especially given the fact that so many countries across Sub-Saharan Africa are holding elections, and government will be tempted in some instances to splurge as part of vote-winning tactics. So let's dive into a bit of economic history. Are there any examples you can give us in the last decade where fiscal slippage during elections has then had negative long-term outcomes?
Indeed, and there are lots and lots and lots of examples. But without naming countries, I should say that what we know for sure is that if you just look at both emerging markets and developing economies, which African countries, all belong to, in one way or the other, what we notice is that primary deficits tend to go up almost 7/10 of a percentage point of GDP during elections. Government spending tend to go up almost half a percentage point of GDP during elections, and government wage bills go up 1/10 of a percentage of GDP during elections. Now, after elections, what we usually see is that primary spending, which is just government spending, gets reversed, almost all of it. But what does not get reversed is, of course, deficits and also the wage bill. So this gets very rigid spending, gets stuck over the years, and then what happens is that it actually really risks fiscal sustainability and lock in spending in such a way that long-term debt sustainability becomes difficult. And then it might, in some cases, also lead to inflation, delaying the ease of monetary policy cycles.
Right. We'll be talking about climate change a little later on in the bulletin, especially given that interesting case coming out of Switzerland. But we've seen adverse weather being among the factors that have driven cocoa prices, for example, to record levels of $10,000 a ton this year. We've also seen March breaking average temperature records. We've had 10 consecutive months of months breaking temperature records pretty much around the world. So from where you sit in the World Bank, to what extent is all this adverse weather likely to retard growth across the region, especially this year?
This is an important point. And we haven't, so the climatic shocks are affecting West Africa, as you just mentioned, especially cocoa, which is a major commodity for both Ghana and Cote d'Ivoire. It's also affecting Eastern Africa, and certainly Southern Africa is engulfed in drought, as you mentioned. El Nino is causing severe drought across much of Southern Africa, which is likely to weigh on GDP. Now, it will take a while for us to basically estimate precisely how much damage this has caused, and there are assessments going on at the moment. But we know from past history and past experiences of these kinds of disasters that adverse weather events will affect growth through particularly disruptions in production, and in particular agricultural production. And when agricultural production is disrupted, then you will get weaker harvests, which will probably push inflation because local supply of food basically becomes a problem. And this will potentially hit household spending power. But it goes beyond just economic impacts. You would also begin to see the number of people with food security problems increase. And then the concerns are that diseases might spread in many ways, and that also affects people's welfare and their productivity, and of course, as a result of all that, then you will get really low economic outcomes.